That. There we go. Welcome everyone. As you come into the chat, I can see already we have a few attendees. We'll just give it a few minutes and give people a little bit of time to jump on and join us. But thank you for joining us here on a Tuesday lunch. We have Hayley on the chat, as you can see there. She'll be jumping in and out and sort of taking and looking at your various questions as they come in. We'll of course have a Q&A at the end where we can quiz John on the ins and outs of gold. But thanks for joining us today. I'll just give it a few more minutes just to give people an opportunity to join us. We'll start very, very shortly. Okay, we might jump into it now, and as we get through these opening slides, I'm sure we'll have more people jump in. So in way of introduction, my name is Jack. I'm the head of content here at Superhero. Today, we'll be talking all about gold, the asset of gold, how to gain exposure to it, and Van Eck will be leading that chat. So just before we start, I'll just jump onto the next slide. Yeah, this webinar is sponsored and presented by Van Eck. Superhero does not provide financial advice that considers your personal objectives, financial situation, or particular needs, or investments carry risks. So please consider carefully before investing. So we will be talking around gold, but of course it's not personal advice. Feel free to jump into the chat, say hello, say where you're from. I can already see Kim jumping in there from Queensland. Welcome to the webinar. Welcome to all our attendees. So I'll now throw to the man leading this presentation. John Caulfield joins us. He's the Director of Intermediaries and Institutions over at Van Eck. More than 20 years of experience in the finance sector, and our ETF expert today. Welcome, John.
Thanks very much, Jack, and everyone at Superhero. Obviously good to be speaking with you again, and welcome everyone who's dialed in for today.
Fantastic. Well, we might kick it off there, John. Do you want to jump into understanding gold?
Absolutely, and we'll do our little disclosure bit as well. Obviously, everything I'm going to sort of say is general in nature. We don't give personal advice as well. So, if there is anything by way of product that does sound interesting, please check the PDS on our website, speak to your advisor, speak to your broker before deciding if it is appropriate. All right, so we're going to run through, obviously, gold, pretty topical at the moment for a number of reasons. Over the course of history, it's probably floated in and out of popularity, at least from an investment perspective. But longevity is certainly something, that gold has illustrated. And again, we'll sort of touch on a few ways to get access to it. Obviously, the current market dynamics, and there's plenty going on year to date. I'm sure you'll agree, globally, we've got a lot of balls in the air, and gold is potentially, an interesting investment option to deal with, some of those dynamics that we're seeing. So obviously gold as an asset class, like I said, it's been around for, hundreds of years. It is the most traded asset class in the world, and obviously holds an intrinsic value. That price does ebb and flow. It wasn't that long ago that we did touch on some all-time highs in terms of the US dollar price of gold. And we tend to see, those sort of spikes in price happen when people are looking for a bit of a safe haven. So, generally when there is market turmoil, and there's obviously other elements, and we're going to talk about inflation, no doubt, and geopolitics and that sort of thing. But, the real, I guess, driver of, gold as a safe haven is when there's distress in financial markets. That's where you really see things come to the fore. But interestingly, it can work in both an inflationary and deflationary environment. And if we look at sort of that correlation chart on the right there, we've got gold miners as the second bottom row and gold bullion. And again, I mean, very worthwhile sort of touching on both avenues because they are both, exposure to the gold price, but you go about it in a different way and you're getting different risk return drivers and they will behave differently relative to other asset classes. And you can see there, obviously gold bullion is, the least correlated of the two other asset classes. And that's why I think a lot of people include gold, purely as a diversifier. Everyone has their views on gold as sort of an investment. And obviously then you have a view on the price of gold. But if nothing else, when you're adding uncorrelated assets to a portfolio, you're improving your overall risk return by lowering overall risk, essentially, because things are zigging and zagging at different times. Now, gold miners, again, slightly more correlated to other asset classes, and that's because you're basically buying equities. So that's not surprising, but again, fundamentally, economically, geopolitically, there are a lot of different drivers that are specific to the gold industry. So like I said, both of those, do have their place, both from an investment perspective, but also from an uncorrelated diversifier perspective.
Well, it is so topical, as you say, John, that we are talking about gold. I mean, obviously 2022 for markets has been a very interesting year. The stock market all over the shop. We've seen some real fluctuations in valuations. And I guess from that point of view, gold is gold seen as one of those assets that can be used in a defensive sense and also like for potential diversification as well?
Yeah, I mean, look, it's interesting that I think gold becoming a bit more in favor probably started in March 2020 with sort of the COVID meltdown. You'd say the prior 5, maybe 10 years post GFC, people had probably moved away from having that little insurance policy, if you like, in the portfolios. And then when March 2020 happens, there's this, wow, gold's held up really well. And if nothing else, it gives you a little bit of liquidity and dry powder to then sort of take some money off the table and invest in other opportunities that get thrown up. So it's been, the last couple of years, I think that, we've seen a lot of clients and advisors revisit, why does gold make sense? And like I said, it can be just purely from an alternative uncorrelated perspective, but just a liquid, is going to hold up better if this volatility continues perspective as well.
Completely. And just to explain the chart that we're looking at there, when we have a correlation of 1, it's completely correlated, linked, and the closer it is to 0 signifies less correlation, I suppose, right, John?
Yeah, no, absolutely. The lower the better. And obviously if there were some negative numbers that move in opposite directions, but you don't find too many things moving in opposite directions at the moment, unfortunately. That's half the problem that we find ourselves in.
If only they did.
Yeah, the good old days. All right, so like I said earlier, look, 2 ways to gain exposure to gold. And so we can sort of run through a few of the positives and negatives on both. Obviously, gold bullion, physical gold, you can either go out and sort of buy, a fund that has access to something like that, or you go and buy the coins or the gold bars yourself. But, you've then got to obviously lock them up safely. That costs you money. There's storage, involved in that. And that particular physical gold is a little bit more like a currency. So you've obviously got some correlations to particular currencies. Being priced in US dollars is obviously the most direct one. No income though. And again, that's, I guess why gold, comes into favor and out of favor. What are rates at the moment? Can I be getting some yield or some income from somewhere else? And that obviously makes gold less appealing, but particularly that physical gold side of things. I mean, you essentially are relying entirely on somebody's valuation of the gold, the price of gold. So, not like owning a company where you're sort of buying into future profits and that sort of thing, and potentially receiving some income off the back of it. And that's obviously where the gold miners, differ. Both are, definitely correlated to the price of physical gold. Obviously, miners, we say there's a beta of around 2, which essentially means if the price of gold goes up $1, the gold miner should go up $2, and vice versa. So it'll move around a little bit more. That's obviously as a result of the operational leverage. You're buying a company, and that company has, fixed costs, variable costs, and therefore profits and margins and the like will move around a little bit. But obviously, you don't need to go down the storage route. You're just basically buying a share or an ETF that holds a number of shares. Correlations, again, are a little bit more towards global equities, let's say, rather than currencies. You've got some regulatory considerations there in terms of what, countries or domiciles do these companies operate their mines in. You need to be sort of wary of the rule of law and that sort of thing. But, at the end of the day, when they're making good money, and we'll obviously talk a little bit about just how good a money they are making at the moment, you will receive the benefits of that as an investor by way of dividends and hopefully some capital growth there as well, if all goes well. So, each has their merits. If you were considering gold, it would be well worth sort of looking at both and potentially blending both in whatever proportion sort of made sense, because they do operate quite differently. So in terms of, what we're seeing at the moment, I mentioned earlier gold hitting all-time highs in back end of Q1, obviously with what was going on and what is going on with Russia and Ukraine. There was this flight to safety. But since then, inflation and rate hikes and all of these things have probably taken some of the headlines, at least from an investment perspective. So we've seen the Fed hiking quite aggressively, increasingly aggressively, likewise down here. And what that's meant, particularly from a US perspective, is a stronger US dollar. So generally, the price of gold will move in the opposite direction to the price of the US dollar. So strengthening USD means sort of weakening price of gold. So over the last couple of months, that's been a headwind for the price of gold, which we've definitely seen. Like I said, those rate hikes are very much focused on inflation expectations. And that's sort of moved pretty quickly from, all sorts of transitory talk last year, which, to be honest, we were never on board with. We always thought it was going to be a little higher and a little stickier than people were talking, and it's certainly proven the case. But like I said, those things are headwinds for gold, but then you've kind of got these overarching risks and uncertainty that, are potentially propping up the price of gold, because it's been reasonably stable, a little bit range bound, we'd probably call it. But, if anything were to sort of turn the other way as far as the rate hikes and the US dollar would go, you've kind of still got this geopolitical risk. Europe is in all sorts as far as that situation goes. There's a lot of unknowns there. And then it's just global outstanding debt. Even before the Russia-Ukraine situation earlier this year, we were positive on the gold sector because we did see inflation becoming a problem. And, the size of the Fed balance sheet at the moment is just, multiples of anything we've ever seen before, obviously GFC included. It's, triple the size. So, how do you actually get rid of all of this debt, or, how sustainable is that? How much faith do investors have in the Fed or central banks generally? All of those things, if the cards start to sort of tumble, gold will be there and will react to that. And as I mentioned earlier, it's those systemic risks, that financial sort of institutional risks, that really will be quite a setup for gold. So, we're pretty delicately poised at the moment as far as all of those things go. Nothing is certain, but a lot of those risks are certainly, not zero probabilities as well. And like I say, that makes the case for, considering something, like gold as that uncorrelated insurance sort of policy as well. And again, I mean, the supply side of gold is something we've been aware of for a long time. There's not a lot of it getting dug out the ground, and there's certainly not a lot getting spent on exploration and that sort of thing compared to history, at least.
That's right. And I mean, we're probably hearing a lot less of it now, but I remember, when sort of Bitcoin was really having its heyday, it was sort of spoken of as a bit of a, digital gold, but perhaps the only one of the few parallels there was this idea of a finite supply. And while, the last few months may have shown that it isn't as steady a store of value, certainly that's something that we consider and we talk about when we talk about gold.
Yeah, absolutely. I mean, there were a lot of, I think, theories, and it was and still is early days on the digital assets side. So a lot to be determined. But I think, a lot of people were talking about Bitcoin as being an inflation hedge and as being a currency. And I think, those views are being tested at the moment. Where we get to from here, I'm not sure. But look, I think, gold and Bitcoin or digital assets generally, should be looked at quite distinctly as different for good reason. And I mean, it's purely how long have these things been around and how have they been used in investment portfolios before? And again, they will just do and have done very different things.
Absolutely, yeah. I think the old saying is an ounce of gold has always bought a decent men's suit over the years, whether you look at 50 years ago or today. I mean, I guess it depends where you shop, but that idea of it as a steady source of value over the years, a store of value rather.
Yeah.
Very important one.
No, absolutely. So just moving on to, I guess, this little illustration. And again, this sort of just talks to how a combination of bullion or physical gold and the gold miners, the equities themselves, do work in tandem together. You can see sort of on the x-axis across the bottom, that's standard deviation, i.e. risk. And the gold miners, as mentioned, will be, more volatile than physical gold, but you put the two of them together, and you're getting a better return than bullion, lower risk than miners. Like I said, overall, that's probably doing your sort of risk return for the portfolio, a better turn than just sort of doing one or the other. But, we say, look, if you are positive on bullion for whatever reason, you should see additional benefits flow through in terms of those gold equities themselves. And I mean, this is one of the reasons why, we are pretty positive on gold equities themselves. And again, historically, if we sort of go back to GFC time, the price of gold was pretty high, but the way the companies themselves were behaving back then, it was kind of expansion and production at any cost. And they were spending a lot of money, and margins were very tight. And there was this assumption that the price of gold would obviously stay high and keep them profitable. And that obviously tailed off. And a lot of those miners came off pretty hard and, had to reassess the business model, the balance sheets, how much borrowing, that sort of thing. But, the pleasing thing is we've sort of rolled forward, call it 10 odd years. And these companies are now exceptionally well capitalized, i.e. very, very low debt. They have only been sort of expanding profitably. So it hasn't been, let's spend all the money and hope that it comes back to us. So there's been a real, I think, conscious effort on their part to provide investors actual return on equity, return on assets. And you can see some cash flow metrics there. Now, bearing in mind, all-in costs are, call it $1,000, $1,100, somewhere around there, US dollars per ounce. We're sitting at 1850 odd at the moment, sort of overnight. So somewhere just above that gray box. So even if, prices were to go down to 1600, you still $500-600 of margin, that these companies are actually clearing. But it's the incremental increase in the gold price that, your fixed costs don't move. Any increase in the gold price is just pure cream. And you can see there between 30 and 40% uplifts in the free cash flow that these companies will be throwing off if you're going 16, 18, $2,000 gold. So, very profitable at the moment, very low debt, very well placed, but the leverage to any upside in gold, which will flow through to the miners' profits, is really sort of there to see.
And I guess that's why we do see such, such focus on gold miners. When the gold price does go up, when, something happens in the world, there is, some uncertainty, the gold price goes up, and then, these gold miners are looking at, increased profit margins.
Yeah, absolutely. And again, going back 10 years, you probably didn't find too many gold miners paying a dividend. And that's because they were sort of reinvesting and exploring and whatnot. And now they're saying, well, look, we will give shareholders back a portion of the profits that we're making. So they're behaving a lot more conventionally. So you do get this kind of yield whilst you wait, if you are expecting sort of the price of gold to go a little bit more. So, there's a reasonable balance of kind of the yield, but potential capital growth as well.
Has that helped, do you think, broaden the market for gold miners in terms of now offering, I guess, a source of income being seen as, a potential income stock? Has that sort of, broadened or increased, I guess, the market base for gold miners, do you think?
Oh, look, I think a little bit. To be honest, you probably wouldn't find too many people going into gold miners purely for yield, but I think it's probably meant that the companies themselves aren't as volatile, because you're not expecting this sort of boom or bust, scenario. It's a lot more steady. And like I say, these companies can cope and operate at varying gold levels. And that, is always good for volatility, because it means, they can survive any sort of downturn, at least for the short time, and allow them to adapt and then benefit when, things turn the other way.
Mm-hmm.
And then if we look at sort of valuations, and it's a little bit of a busy chart, but, basically gold equities is that dark blue line. So you can see at the moment, we're sort of hovering at sort of reasonable lows, probably a little bit higher than, the all-time low. So that's the equities, dark blue. That teal sort of blue line is the price of gold. And now you would expect, these two things to move reasonably in sync. But you can sort of see the longer term average is the black line across, and sort of the reddy line is the current average. So at the moment, equities are trading a lot cheaper than, the traditional ratio between themselves and the price of gold. So where we have actually seen, gold, run up, whether it was sort of 2019, 2020, come off a little bit, run up a little bit again, we haven't actually seen, the reaction from the equities that we have in, previous cycles. So from our perspective, there's a potential opportunity there for that sort of gap to close. And we did see, even in March 2020, some of the equities got sold off, with the general market downturn, and haven't quite sort of bounced back to the extent that everything else has as well. So again, it's sort of an interesting setup there, just to sort of say, well, look, the gold price is doing one thing. Have we actually seen the equities reflect that? And we don't think we have, fully seen that.
What's the idea between that lag? I suppose that we are looking at historically below average valuations there, ratios.
Yeah, I mean, look, not sure, to be honest. Like I say, we think the companies are well capitalized, throwing off a lot of cash, should have that traditional kind of 2-to-1 almost leverage to the price of gold. But look, they are equities. So, people need to be happy with that kind of element of the investment case. There's always going to be a time where, something will change, and, it'll just, take off potentially, which, we've seen in previous cycles. I think the start of 2016, was one in particular where, again, I mean, that was when the all-time low ratio was, and, the gold equities themselves, I think between February and August, almost doubled, and then obviously tailed off a little bit. But, there was nothing specific at that time, but it was just the market maybe sort of sensing that there was a little bit of value there. So again, when, people maybe just get a little bit more comfortable that, these miners can maintain and then benefit from any uptick in prices, we may see a revaluation.
Fascinating.
Yeah. And then, yeah, good old inflation. Again, I mean, just looking historically, this is, 50 years. What has done well when inflation has been at various levels? And you can see across the bottom there, obviously less than 2%, between 2 and 6, or above 6%. And, we're firmly, particularly in the US, in that above 6% bracket at the moment. So, we do have this very high inflation. But as mentioned earlier, we do have rates going up pretty quickly from a very low base. We've got a very strengthening sort of US dollar as a result of that. So there's kind of this tug of war going on at the moment, where there is high inflation, but there are a few other headwinds going on. So, how that all works itself out, generally speaking, real rates being negative is a positive sign for a gold bull market. So you sort of think, okay, well, nominal rates at the moment are, for ease of simplicity, 8%. Inflation's running at 8. You've got real yields of -7. I mean, that's pretty big. You should be seeing, a reaction from the gold market as well. So whether it just takes the Fed slowing down a little bit in terms of their rate hiking, we don't think they're going to necessarily do a U-turn anytime soon. But, this cycle may be a pretty short one. They may hike for a year or two and then be forced to cut again, because we've obviously seen GDP and global growth numbers be revised down across the board year to date. The US was the standout in terms of their economy, particularly relative to Europe and China. Obviously, the Chinese numbers have been revised down because of the lockdowns and COVID zero. We've seen Europe revised down for obviously the geopolitical reasons, but now we've obviously seen, the US start to potentially slow down as well with, reduced spending, cost of living up, all that sort of thing. So you've kind of got inflation still up there and, potentially peaking, but maybe not quite yet. We'll see. And then growth coming off. So again, you start hearing stagflation as a term being thrown around, which is obviously that combination that you don't want of low growth and high inflation. And then, you've basically got these negative real yields and Fed hiking potentially into a recession. Again, it just brings all of those sort of risks to the fore again. And like I said, it may not take a complete reversal in terms of cutting rates or anything like that, but any sort of slowdown or any sort of indication that, things are not going to be, as dramatic as possible as far as that hiking and that strengthening US dollar goes, could take away some of those headwinds and be very good for gold. So.
Absolutely. Well, it is such an extraordinary time on markets where we'd seen, this enormous kind of bull run look like it's turned a little bit inflate. You can't turn on the television without hearing the word inflation. Yeah. And it does make for a very interesting time to look at gold as an asset and what it can offer.
Yeah, absolutely. So, we've touched on a little bit of this already in terms of where it's headed and some of the things that could drive it. But a bit of a quote from a colleague of mine who's sort of a US-based gold strategist. He's been doing this a very long time and has seen a lot more cycles than I have. But again, it's really just to say there are a lot of these risks out there in the market. They were there before Russia. They were there before inflation became the topic of the day. And they're not trivial risks. They're not, non-zero risks. So we need to consider, how is our portfolio structured to cope with, whatever route the world sort of goes down, over the second half of this year. So, like I said, there are a lot of good reasons, to have gold in the portfolio, whether you're sort of positive on the bullion, whether you just want something uncorrelated and a little bit defensive. We think it makes sense to consider. I think that's it from me, but yeah, obviously happy to sort of run through any questions or cover off anything else that wasn't done.
That was fantastic, John. That was great to go through that. I'm just flicking to the Q&A. So if you are in the chat, feel free to open up. There's a Q&A section, so you can run over there. You can ask a question, and I'll put it to John as we chat through. So feel free to do that. I'm just having a look now. It doesn't look like we've got a rush of questions just yet. But so I might start with one. In terms of, I mean, obviously all investors are different. They've got different goals, objectives, and that kind of thing. But is there when it comes to I guess thinking about gold in terms of a portfolio, thinking of it as a defensive asset or a means of diversification, has there been like a rule of thumb, I guess, when it comes to thinking about what percentage of a portfolio that gold could potentially make up?
Yeah, I mean, look, to be honest, like you say, it's a very personal thing. If you had to do sort of a ballpark back of the envelope, an easy number is kind of a 5%. And then it's sort of, okay, well, do I do 2.5 in physical, equities, something, of that nature, I think is probably reasonable as a starting point. It's a portion of, it's not the bulk of generally a portfolio, but I guess, I mean, it's everybody's personal choice, and it depends on, where you're starting from and what you're trying to actually sort of alleviate or address in terms of the other parts of the portfolio. That'll get you to your final number, I think.
Yeah, and that is the case, isn't it? You do have to consider what you're comfortable with, your allocation to growth and all sorts of things. And in terms of investing, I mean, as you touched on it at the start of the presentation, there's obviously a myriad of ways to gain exposure to gold, whether it's, buying the physical bars on sort of one end of the spectrum, ETFs, gold miners, that kind of thing.
Yeah.
In terms of ETFs, if we could talk about a bit about that, because there are gold ETFs out there. They do differ in different ways, whether they hold gold miners or whether they hold physical bars, or whether they don't actually hold the gold, the solid bars to your holdings. Could you sort of talk us through that? I guess things to look out for when you are looking at potentially looking at investing in gold ETFs?
Yeah, I mean, look, we offer a gold equities ETF, so I'll sort of start there. I mean, all that does is hold the largest and most liquid gold miners listed around the world. Obviously, there's this sort of Canadian, North American centric element to the gold sector. There's obviously quite a few locally listed gold names as well, which do feature pretty strongly. I mean, I think from our perspective, when you're looking at the equity side of things, a lot of these companies do have very specific risks. So if you are trying to pick, one company over another company, your outcomes could be pretty diverse. Whether it's a flood in the mine, I mentioned sort of politics and regulatory sort of considerations. There are a lot of risks to consider over and above just the price of gold. So we would sort of suggest taking a portfolio approach, and that's where an ETF can be really useful. You are buying the sector, you're nicely diversified, 50 odd names in there. You do get that, correlation and exposure to the price of gold, but you're not taking specific stock risk. So you're sort of alleviating some of those problems there. On the physical gold side of things, you're right. I mean, we don't offer one in Australia. There's a different sort of way to go about it. It could be sort of warrant based, i.e. you get a sort of piece of paper saying you have some, right to some gold somewhere. And then there are other ways where it's, this is literally your bar of gold and you've got the number. And, if you wanted to chop it in half and take it home with you, you can do that. So I guess just understanding, the different providers and how they've approached things, and, is the gold in the vault or not? Or are you holding miners, and where are those miners listed, and that sort of thing? It's always good, whatever ETF it is, whether it's gold or not, you've got to kind of take that sort of look through approach and understand, the index that the ETF's potentially tracking, and obviously the companies or the bonds or whatever it is that is actually being held, to really understand what you're going to get in terms of those outcomes.
And I know we sort of looked at how the price of gold, affects that kind of free cash flow, and obviously the higher the gold price, there's some real tailwinds for gold miners and investing in gold. How important, I guess, is it? I mean, we're looking at about I think, as you said, about $1,850 more or less per ounce of gold. How closely, or how much weight, I guess, should investors give to the price of gold? Should they be sort of following it, be concerned if it dips a little, cheering if it rises a little bit? Like, yeah, how much weight should they put on that gold price?
Yeah, I mean, look, in terms of the equities themselves, like I said, you're kind of getting a 2-to-1 relationship, roughly speaking. So you will see, if the price of gold goes up a couple of percent overnight, you'll see sort of the equity ETF or some of the stocks go up potentially 3-4%. So, it certainly has an impact. But, going back to that all-in cost equation, and, you've got 1,000, 1,100, somewhere in that ballpark, as far as all-in costs go. There's a lot of wiggle room in terms of these companies being able to remain profitable at lower gold prices. And again, I mean, that colleague of mine in the US, the way he was sort of talking 2, 3, 4 years ago, was sort of saying that the good thing about these gold companies now is it's not necessarily sort of the geologist that's running the company, i.e. I just want to dig stuff out the ground. It's now the CFO that's running the company. So, they're being a lot more conservative in terms of how they operate. We haven't seen this sort of crazy M&A where they're paying, insane multiples to take over a junior sort of explorer. There's been a lot more of this sort of merger of equals where there has been some corporate activity. So in other words, we are going to, buy your exploration capability, but we're not going to sort of pay over the odds. And, you can then benefit from our scale as a larger, more diversified gold miner. So I think the way they're behaving at a corporate level, again, is, probably a little bit more important than, $10-20 price of gold either way.
And we just had a question in the chat. I'm going to paraphrase it a little bit. So it's asking about looking at purchasing and holding physical gold. And sort of, I guess, a question of, I won't name the specific company because I don't think you can weigh in on them necessarily, but I guess the importance of, a good reputation in terms of reliability, financial stability, and the risks there. Could you just talk a little bit about, I guess, some of those considerations that you need to make when you're looking at maybe making those purchases?
Yeah, I mean, look, I'll speak very generally. As I mentioned, sort of, we don't have anything physical gold locally that I can use to illustrate, but, reputation, absolutely across the board, anything investment related. You're essentially handing money over to somebody, to be a custodian of your assets. How long have they been around? How long have they been operating, in that particular sector? The investment vehicle itself, how long has that been around? Has it been behaving as you would expect through, different market cycles? When it comes to gold itself or gold bullion, I think ideally you would want a little certificate saying, that bar of gold that's in that vault over there that has this serial number is the one that I have a right to basically go in, pick up, walk away with, in simplistic terms. So again, how that provider goes about providing that access, whether it's, like I say, direct to a bar of gold, or whether it's just a piece of paper saying you've got this kind of unitized, element of ownership. Those are certainly things that need to be looked at in great detail. Like I said, I can't really sort of talk to the minutiae of that, but yeah, absolutely. I mean, as with any sort of investment ETF, know who you sort of handing over your money to, and make sure they're sort of trustworthy, been around for a long time.
That's right. And we've got another question here from Janine. Thank you for the question, Janine. She says, good morning from country Western Australia. I'm a small investor. She's bought into a gold company, still in the early stages. She says she bought it at 1 cent per share. She's hoping over the long term she's going to get a return. She sort of asked, is it worth buying more? And we obviously can't comment on what she should do with that. But I guess that raises an interesting question as well, I guess, in terms of gold miners and different sizes, different stages of development. If this is at 1 cent per share, I assume it's sort of perhaps more in the exploratory kind of phase of things, just discovery. Could you talk a little bit about that? I guess when we're looking at gold miners, they obviously do come in all shapes and sizes. Maybe some of the considerations that investors should have there.
Yeah, I mean, again, that probably goes back to my point on individual single stock risk versus buying a broad portfolio of stocks. Like you say, 1 cent per share is indicative of a very early stage company. So, probably, not necessarily digging stuff out the ground at the moment. So, those sort of risks are quite far removed from what is the price of gold doing at the moment. Because if you don't have any gold to sell yet, like I say, that's a problem for another day. So again, obviously can't sort of talk about individual companies and they will have very specific risks that may override, whatever's actually happening to the price of gold anyway. So, you need to be doing all sorts of due diligence on the individual company itself. I think even before you worry about what the price of gold or what inflation's doing, if you're trying to get exposure to the sector, it's probably safer to be a bit more diversified.
That's right. Yeah. And I guess sort of zoom out a little bit from a bigger picture kind of view. The last few years has obviously been sort of a lot of uncertainty. You were talking about March 2020. There was sort of this rush towards maybe more defensive kind of assets. Sort of the last 18 months, we've seen sort of, quite an impressive bull run on equity markets. And now I think, there's a little bit more uncertainty setting in, whether it's inflation, raising interest rates, talk of potentially recession, all of those kinds of things. I mean, in your view, I guess just sort of zooming out and looking at the macroeconomic picture, do those things seem like they are, here to stay for quite a little while from where I'm sitting? Can you just sort of comment, I guess, a little bit on what we are seeing and what that means for investors who are perhaps looking for, more defensive style assets?
Yeah, I mean, I think the short answer is the volatility is here to stay for the short term, for sure, in our view. We are obviously coming out of sort of an environment, and whether it's a low rate, no inflation environment that we've been in for a long time, and we haven't really hiked rates from such historic lows before. So I mean, it's very much new ground. What traditionally has been defensive has been fixed income. Now, when you're lowering rates, and again, this is a simple sort of generalized comment, but as rates go down, the price of bonds go up, fixed rate bonds at least. So the defensive bucket has actually been pretty profitable over the last sort of 10, 15 years when we've sort of had these structural declines in rates. Now, there's only kind of one way to go when you're at zero, and we've seen fixed income come under a lot of pressure. So the defensive part of clients' portfolios, traditional defensive parts, have also been, not doing as well as they were potentially thinking. So it's been very difficult from a portfolio construction perspective. So, I mean, what does that mean? You, again, try and sort of go back to Finance 101, am I diversified? Do I have a handle on, any fees across my portfolio? Am I sort of, paying as little as I possibly can for the outcomes that I'm hoping for? Do I have most asset classes covered? Do I have an allocation to cash, like I was saying earlier, some dry powder, where, if you do think that there are some opportunities being thrown up through the volatility, you can actually take advantage of that. So, like I say, having good advice, having a good financial advisor, broker, whatever it may be at the time, can potentially save you from yourself, but also put some interesting opportunities in front of you. So, I'd say try and not overcomplicate things because it is very uncertain. Nobody kind of knows where we're going to from here. So the more simple you keep the portfolio, I think the better at this stage until things probably settle down a little bit and there's a bit more clarity.
And we've got another question here from a guest. They've said, what effect, I'll read the question out. What effect has there been on the global price of gold as a result of Russia pegging the ruble to gold? I'm interested, I guess, in the impact of that. I'm not sure whether you've got any thoughts on that, John.
No, look, nothing specific. I mean, even if you peg rubles to gold, nobody's going to want your rubles at the moment. So it's not making too much, difference, I don't think. Again, sort of historically, when there was a gold standard, and we go back to sort of the 70s, and the US dollar was pegged to gold when somebody came and said, well, look, here's all the US dollars I have, give me the gold, and they couldn't. That was when the gold standard broke down, and that's when we got into that sort of high inflation, stagflation, late 70s, 80s environment. So, in some respects, there are a few parallels going on at the moment, but probably nothing, Russia specific. Again, they had, I think it was, 600 billion of US dollar reserves pre-crisis, and all of that was kind of frozen now. So again, they probably didn't sort of rely on, gold necessarily as the bulk of their reserves. I'm sure they probably increased it over recent years when, sanctions were increasingly in place. I think, you'll probably see a lot of countries now potentially look to use gold more than historically relative to their US dollar reserves, because, they'll look at the Russia situation and go, okay, well, if I'm holding 600 billion of US dollars and suddenly it's worth zero, or I can't use it or get it out, maybe I should be holding more gold. And again, China is the biggest holder of US treasuries, maybe saying, well, maybe I shouldn't be buying up as many of those as I have historically, and maybe I should be buying up some more gold. So again, I think that dynamic of which currency am I holding, again, is an interesting one going forward, and we may see some changes, which again, I mean, looking long way into the future, if you don't have people buying up as many US treasuries, you don't have as much demand for US dollars. So the US dollar isn't as strong somewhere out in the future as well. So again, nothing very, very immediate or short term, but the chicken and egg dynamics of global financial systems are being sort of revisited, I think.
That's right. Well, I mean, fascinating to sort of look at it and think about, what could be and what we're seeing on the markets now. And certainly gold is a fascinating kind of lens to do it through. I think that's all the questions from our participants. So I think that might be the place to wrap it all up. Thanks so much, John, for running through all of this with us. I feel like we covered significant ground. Really fascinating conversation. I certainly enjoyed it. I hope all of our viewers did as well. So thank you, John, from John Caulfield from Van Eck, for running through that with us. And hopefully we'll get you on another webinar soon.
No, perfect. Thanks again for having me. Always a pleasure. And we'll be happy to chat in the future. Fantastic.
There will be a record. We have recorded this webinar, so it will be available on the Superhero YouTube channel. If there's any other questions you have, pop them in the chat, and our customer service team will get to them via email. But other than that, enjoy the rest of your Tuesdays. Good luck out there, and we'll see you again soon. Thank you.